What's up, everybody? Today, I wanted to throw out some thoughts about moving fintech on chain, the challenges of moving fintech on chain, and some of the ways we're thinking about addressing these challenges at Optimism. Then I wanted to give a quick update about what I've been working on in particular. So let's start off with a brief history of modern finance. I'm going to start with a few definitions. Obviously, these are just labels. They're just memes that help us tell stories, so don't put too much weight behind them. First, there was TradFi. In the beginning, we just had banks, brokers, exchanges, insurers. These are the oldest financial institutions. These are permissioned slow rails. If you ever rolled over a 401k and you received a check in the mail, and then you had to put that check in another envelope and mail it to another bank, not only have you experienced TradFi rails, but you were part of those rails that keep the traditional financial system moving. Next came Fintech. This is tech-enabled financial products and services powered by and sit on top of TradFi. And overall, they improve the UX of these older rails via modern development, software development, escrow, IOUs, and risk management. Next came CeFi. This started in 2010 with Mt. Gox. CeFi companies offer crypto-based services similar to both TradFi and FinTech, things like exchange, lending, stablecoin issuers, but they do all this with crypto assets under the hood. And finally came DeFi. This started in about 2017 with Make or Die. These are automated financial services implemented through smart contracts on Ethereum. These are non-custodial, permissionless, transparent, composable, minimal to no intermediaries, essentially peer-to-peer finance as a protocol. And these categories are not mutually exclusive. Most companies involve some piece from many different categories. If we just use Coinbase as an example, from TradFi, they've got bank integrations and payment processors. From FinTech, they have stablecoin integrations with Shopify and Stripe. They have on-ramp and e-commerce service offerings. They are the largest US CeFi exchange. And from DeFi, they've recently embedded Morpho lending under the hood of their exchange app. So without signing any transactions, you can put your funds into DeFi. They obviously run one of the largest L2s, and the wallet app that they have supports most DeFi protocols. So again, most of these companies exist across many different layers, except TradFi and DeFi. These two components, or these like stacks, have the most components in common. They enable underlying banking actions like lend, borrow, swap, pay, yet they're fundamentally architecturally opposed. And we've seen a trend for a few years now. We've seen TradFi moving on chain. Fidelity, JP Morgan, Morgan Stanley, BlackRock, a bunch of European banks have all begun tokenizing funds, integrating stablecoins, and embedding DeFi under the hood. We've seen last week the New York Stock Exchange announced development of trading and settlement of stocks and securities on-chain. Tokenized assets like gold have continuously expanded on-chain. We've seen fintech moving on-chain. Robinhood, Revolut, Stripe, Shopify, PayPal, SoFi, Square, and most popular fintechs at this point have all integrated crypto, stablecoins, and DeFi into their offerings. CeFi companies, at this point, most of them have launched their own chains. They're moving more of their business on-chain, and they're embedding DeFi deeper into their back ends. So it's safe to say that more than just fintech is moving on chain, all of finance is moving on chain. And it makes sense, right? DeFi is open, public, borderless, neutral, censorship resistant, permissionless, disintermediated, transparent, fast, cheap, global, peer-to-peer, non-custodial, and easily innovated. And TradFi is not any of those things. DeFi is an order of magnitude improvement over TradFi. These permissioned layers can always be added on top, but a hardened, permissionless, open source, trustless foundation will always breed more efficiency and innovation. We saw it with the internet. We saw it with Linux. The attributes of DeFi are far more suitable to the needs of modern financial products than TradFi, and the attributes of Ethereum are far more suitable to the needs of DeFi than any other layer one blockchain. And these properties aren't just useful to finance, right? Finance is the obvious first use case. It makes the most economic sense to find product market fit first. But for those of us that have been plugged into this niche for a while now, we've seen that Ethereum can be used to reduce platform risk, to align incentives, to fund public goods, strengthen societal coordination, increase trust in institutions, improve civil resistance through proof of humanity, create a foundation for UBI experiments, unbundle the layers of social media by separating the social graph from the algorithm from the content, and ultimately reduce the need to give billionaires complete control over the internet. And these are just a few of the things that make me optimistic, but I'll save that talk for another day. If you have a chance, check out this report from Etherealize, Nethermind, and L2. It's about the future financial infrastructure Ethereum's layer 2 landscape. Today, subcent global transactions of any size are now standard. Stablecoins processed more value last year, 27 trillion, than Visa's entire annual payments volume. And JP Morgan moves $2 billion daily on Ethereum rails. And real world assets, we have about 20 billion in real world assets currently on chain. That goes up to about 300 billion if you include stablecoins. And if we go over just a quick case study of Base, over time we've seen Coinbase launch more products and services on chain with deeper integrations into DeFi as their total value locked continues to grow up and to the right. A third of Base's TVL today comes from their CeFi integrations and are expected to contribute to over 50% of their TVL in less than a year. In the last year, they scaled to about 2 billion in deposits, earning their users 4 to 6% in stablecoins along the way, which is obviously higher than any TradFi bank. And these are hyperscalable services, right? Incremental complexity of additional markets is zero. Cost of capital to offer on-chain loans is zero. Balance sheet impact is zero. Cost to maintain licensing is zero. Origination fees zero. And this is cheaper access to credit than credit cards. So it's unsurprising that we've seen their on-chain borrow product continue to grow almost vertically over the last year. But Coinbase is crypto native. They were born in crypto. They have a lot of expertise needed in order to build these financial products. And despite the sleek UI of modern payment apps, the rails underneath are still overwhelmingly ancient, expensive, and slow. So there's this large opportunity to help fintechs move on chain, but there are obviously plenty of challenges in doing so. First, we've got a set of challenges in just the general knowledge gap. Most people don't realize that stablecoins are the boring, unintuitive first killer use case. Most believe crypto assets are trying to compete with the dollar. They don't realize that the most popular use case is the dollar. They see headlines about meme coins and scams, and they don't even know that DeFi exists. And if they do know it exists, they don't understand that DeFi is replacing the back end of finance, not the front end. In the end, the average DeFi user will not know their money is moving on chain. From the end user perspective, DeFi mass adoption will look like their bank offering higher interest rates and faster payments via more efficient rails. Next, there's the technical knowledge gap. Learning how to develop software on the EVM is more than just picking up a new language or framework. The EVM has properties that most web devs are not used to. Blockchain scaling is unintuitive from the perspective of modern web developers. Typically, you would prioritize speed over all else, and this intuition does not translate when it comes to layer one scaling. Next, we have the regulatory gap, another talk all on its own. This is an unsolved gap. Compliance is complicated and unclear. Even just this week, we've had updates on the Clarity Act. It's an ongoing battle. Financial cost. I mean, once a fintech realizes that it makes sense to move on chain, then they have to pay that cost. The upfront investment to run an L2 is extremely high. It typically involves hiring a team of engineers with hyper niche technical context. It's anywhere from $500,000 to $1 million, or even multiple millions of dollars in infrastructure costs, depending on the usage of the chain. And running the L2 is really only the beginning. You need a ton of partnerships with bespoke financial contracts and agreements. You need RPCs, a sequencer, block explorers, bridges, assets, external wallet support, embedded wallets, transaction simulation, oracles, indexers. You need DeFi contracts, DeFi front ends. This is just the tip of the iceberg. There's the R&D costs. This is a constantly evolving ecosystem. New EIPs are written daily. New hard forks roll out every 6 months. Like most software, to keep your L2 up to date requires this ongoing investment. There's the stack choice. There's a ton of nuance in determining which blockchain stack to go with. Many fintechs have burned millions of dollars attempting to move onto fully permissioned rails that are effectively just another company's database. Many fintechs don't realize why Ethereum is the best security layer or understand the benefits of launching an Ethereum layer 2. The stack choice is a tough decision. Obviously, I'm joking here. Optimism is the clear choice. As of November, the superchain GDP sum of fees generated by dApps on the superchain expanded past 852 million. OP stack chains earn up to 3 times more profit, 2 times more revenue per dollar on chain than the most successful chains of other L2 stacks. 50 plus chains in production on the OP stack, 6.1 billion in TVL, 58% of all L2 transactions on the OP stack, and 14% of transactions in crypto overall. Source is that Jing said this on Twitter, and I trust her. Optimism is the obvious choice, but the chain is only one decision. There's a whole lot that we talked about that is involved with running an L2 and getting it off the ground. Even some crypto native CeFi companies that have their own chain are struggling to get all of these pieces together. And we do see a future where fintechs continue to launch their own L2s, but they shouldn't need all of these pieces and they shouldn't have to figure them all out on their own just to start moving on chain. Obviously, today we announced OP Enterprise as a way to help fintechs run their own chains. I'm super excited about this announcement. Go check it out. But if launching an L2 is still the deep end of the pool, we need to keep making it easier and easier for fintechs to integrate DeFi from existing chains with existing assets. And we need to let fintechs dip their toes in, see that the water is warm, and then help them run their own L2. For that, we're working on Onchain Actions SDK. It's an open source TypeScript SDK for letting your users easily perform on-chain actions, lend, borrow, swap, pay, and ultimately consolidate the decisions and configurations needed for fintechs to move on-chain. The intention is to reduce the friction of offering DeFi yield to TradFi customers. So I'm going to give a super quick demo on Actions SDK. The gist here is that we combine embedded wallets. Today we support Privy, Turnkey, and Dynamic. We make it super easy to spin up smart wallets, to add signers that are connected to embedded wallets. And ultimately, the user experience just looks like signing into their email or using a passkey without necessarily needing to go download a browser extension and write down a series of 12 words. From the lend action, we've launched with Aave and Morpho. This allows you to open positions, lending across markets, easily add support for all providers of lend, and embed both in your app without needing to do all of the work necessary to integrate each individual provider. We're working on borrow, we're working on swap payments, and ideally payments that bridge without the developer needing to worry about all of that. We support assets that can easily be imported by the developer, things like USDC. We don't need every single fintech to hard code the USDC addresses on every single chain, but if they do have custom assets, we allow them to fill out which chains and addresses they care about. And finally, integrating across multiple L2s should be super simple, as we'll see in the demo shortly. If we go over to the demo, we are showing off both Aave and Morpho, base Sepolia, and OP Sepolia markets kind of across the board, so we can lend out our 100 USD. And yeah, I think it made sense why early DeFi needed to orient the application around an individual chain, but as fintechs move users on chain, their end users don't necessarily need to see or care about which back-end markets and chains are being used under the hood. So you can come check this out. You can check over under the hood at which on-chain actions functions are being used to power which components on this app. And then finally go check out the documentation. Makes it super easy to get on-chain actions spun up on your application. So I appreciate y'all for taking the time, and I'll talk to y'all next time.